name is Rebecca Christie. I am a non-resident fellow at Bruegel here in Brussels, and I am joining you live from the studio to lead you through this next panel on this morning's Swiss Finance Council discussion. Very delighted about the panel that we have today and the conversation that we have coming up. So thank you all for sticking around. We are going to be discussing the recovery and the way forward from the pandemic and what's needed in the bank regulatory sphere. We have with us Mark Branson from FINMA, Carolyn Rogers coming to us from the Basel Committee. Thank you so much. Also, Paulina Hack from the Commission is supposed to be with us. Kerstin Joknik, I see on the screen. Thank you so much. Nice to see you again, if virtually. And then Axel Weber is going to continue to talk this through, which is great because I have some questions for you about your proposed EU bank charter and what that means for the way that our banking system goes together. Let's see. We are going to start out by talking about the current situation and how to withdraw from the various support measures and how we should look at that. Then we will look forward at some of the prudential lessons that we can learn and also the outlook for the Basel Committee. Carolyn Rogers has to leave us a little bit early, so we will probably discuss the Basel process a little earlier in this panel than we might have otherwise. And thank you to all of my fellow banking nerds for hanging out with that because I am very interested in how that's going to work out. And we'll also talk about legislation that can happen at the EU level, which will give us a chance to circle back to some of the themes that we had. Let me just check with my moderators. Do we have everyone online? Are we ready to move forward? Is Paulina with us? She's coming. Okay, we don't have a camera for that. The way this is going to work is I'm going to ask you all each questions. For the first panel, the order of speaking will be Mark Branson, Carolyn Rogers, Paulina, if we have her, then Kerstin, and then Axel Weber. And, oh, good. Hello. Good morning. So glad you could join us. And then for the subsequent questions, we will see kind of how the conversation goes and flows from there. So the first thing I would like to ask each of you is briefly if you could give us an assessment of the current situation of where we stand after the pandemic, particularly from the perspective of the global and the European banking sector. Banks have not contributed to the crisis this way in the way they have in the last economic cycle. There is a concerted effort at the G20 level to fight back against market fragmentation. So where do we stand and where should our priorities be? And Mark, we'll start with you. Thank you.
Okay, thank you very much, Rebecca. Can you hear me?
Yes, we can.
Good. Okay, very good. Well, where to start? I think obviously we're still in a state where the future path of the financial sector is very uncertain, and the future health of bank balance sheets is also to some degree uncertain because we're in a type of crisis which we haven't experienced before, and one where obviously fiscal support for the economies has done a huge amount of lifting for a prolonged amount of time, and the path forward is not one that has a lot of clear visibility. What we do know is clearly that in many of our economies, the level of support for the real economy has been not only unprecedented, but has to some degree overcompensated the degree of restructuring that you would have seen in normal times. So we have insolvencies running at a lower rate than we would have done otherwise. So there is some trouble stored up in the pipeline. We don't know how much. We don't know exactly where, although we can have a good idea of maybe where to look. And we don't know when and in what form it will crystallize. So we need to be very clear that the robustness of the financial system and the banking system is extremely important right now, that the buffers that have been built up were there for these kinds of situation. Let's face it, after the pandemic, the economy will not be in a better shape. The world economy will not be in a better shape than it was in 2019. It will be damaged, and some of that damage will flow through the financial sector in some way. So what is absolutely critical is that banks' risk management practices stay sound, undermined or overruled in any way, because the most helpful bank is a sound bank, and we have in most of our jurisdictions sound banking systems right now, and that's the biggest help that we could have going forward. I think there is another aspect, and when we move away from just the solvency of banks, that should concern us as supervisors and regulators, and that's maybe the state of the market environment. Given the environment we're in, the search for yield, the pumping of liquidity, we do have an environment that has, at least in pockets, what looks like a lot of froth. And that in itself has risks. It can have risks for the banking sector, depending on how the banks participate. It has risks for the non-bank financing sector, used to be called shadow banks. Maybe we should retire non-bank finance as a term, and go back to talking about shadow banking. It also has, in particular, risks for investors. And we've got a lot of things popping up in the market environment, which should give us cause for concern. Yeah. We have crypto tulips. I thought there must be crypto tulips because that seems to be the phase we're in. And I looked on the web and I found indeed there are crypto tulips, which sell themselves as being a way to participate in the tulip mania that you missed in 1637, and don't miss out because the prices are rising exponentially. We have crypto tulips, we have celebrity SPACs, we have lots of more mundane types of valuation excesses in the market. So I would say that investors have to think very carefully about where they're placing their money. Stories that are look too good to be true are probably not true, and banks and all sorts of financial advisory firms have a role in advising their clients to stay away from the pitfalls. So I think we've had phases in the past where the music has still been playing and the financial sector has kept dancing. There's a bit of dancing going on at the moment, I think, and nobody can ever call cycles. But I do think we have to be very aware that there are side effects of the unprecedented stimulus, and those side effects are to be found in various markets. And when that turns, for whatever reason, things will pop up, be they fraud, be they valuation corrections of a certain speed, which have in themselves their risks, not just for the financial system, but for their clients. And so as partly responsible for trying to protect some of those clients, also from themselves sometimes, I think it's important that we talk about that.
Carolyn, how do things look from where you sit? It's been an exciting time and lots going on.
Thanks, Rebecca. You can hear me all right?
I can, thank you.
Perfect. So thanks to the Swiss Finance Council for the invitation. Exciting. Exciting is one word for it. Tulips is a new term I've heard. Trust Mark. That's a good one. So what have we learned so far at the Basel Committee table? Resilience. So resilience mattered going in. It gave both banks and supervisors room to be flexible and respond to an extraordinary set of circumstances. It matters where we are now, which I would call early or at best midway through this crisis. We're certainly far from the end. The narrative that has come to be popular is that banks are part of the solution, not part of the problem. But there's a lot that has to happen for that to continue to be true. So resilience matters at this stage, and it will matter coming out too, as we heard earlier. There's both the SME sector, the corporate sector, and households will all need continued support in the form of lending. So banks are going to need to keep that resilience, and I think that's going to be the hardest phase. So resilience going in was there thanks to the reforms coming out of the financial crisis. Resilience now is there in large measure due to huge levels of fiscal and monetary support. It's the third stage of resilience that I think will really be the true test of whether banks can continue to claim that title of part of the solution and not part of the problem. So we have a ways to go. As Mark said, there's a lot of fog in the windshield. There's a lot of froth in the market. There's a lot of liquidity sloshing around the system that we know can create valuation problems, asset bubbles. Banks are not immune to the impact of those. So we've got a long way to go. It's time. We need some optimism, certainly, for the purpose of the economic recovery. But good financial supervisors, good bank supervisors keep their optimism in the back pocket for now, and I think are continuing to be vigilant and encouraging their banks to continue to be vigilant.
So much. Paulina, we've seen the Commission change its regulatory priorities very quickly over the last year to focus on fighting the pandemic. Where do we go from here, and how do we work back to the regulatory agenda that was put on hold, and how does that look with the state of, as Carolyn just said, not being even possibly halfway through this cycle?
Good morning. Thank you, Rebecca, and good morning to everyone. And thank you to the Swiss Finance Council for inviting me or giving me the opportunity to be on this panel this morning. 3 points briefly from my side, touching on the banks, the fragmentation, and also the priorities going forward. I think a lot has been said already, and I don't think I shall not repeat what Mark and Caroline have said. But it's clear that I think up to now, the banks have been part of the solution. If we look at corporate lending and lending to citizens, it has continued through the pandemic. But as has been mentioned, of course, this is also or very much due to the very massive fiscal support measures of different kinds that are in place. So we need to be very vigilant and cautious going forward. We know that these measures cannot be permanent solutions, and when they are phased out, and this phase out is of course starting already in some countries, we have to be very, very vigilant. There is a risk, obviously, that NPLs, for example, will start going up at some point. We published from the Commission side last year a new action plan on the handling of NPLs, precisely to trying to preempt that discussion and see what can be done to help the banks to deal with the NPLs, notably to create a good secondary market for NPLs, which of course remains a bit of an issue. Coming then to fragmentation, I think it's inevitable that this kind of crisis has a fragmenting effect. It goes far beyond the financial sector. If we look at the impaired supply chains, border restrictions, we also had in Europe, 1st of January this year, an event which was very fragmenting in itself, which was Brexit, which obviously we also need to, let's say, deal with going forward. And the question is then, how do we do this? I think part of the reply to the fragmentation has to be international coordination and cooperation. That was what worked well in the global financial crisis back in 2008, 2009. I think the good thing now is that the US is back on the table, and I think we've already seen over the last year the good cooperation, be it in FSB, be it in the Basel Committee, and of course we have the G20 and the G7 agenda, which also puts a lot of emphasis on the coordination. So I think that will be important. Exit strategies to be coordinated within Europe, but of course even better internationally and globally. And I think that is part of the solution. I think that is part of our reply to the fragmentation that we currently see. In terms of priorities going forward, there's a lot to be done. I'm sure we will get back to the Basel work, and from our perspective, of course, also the anti-money laundering agenda, where we've done a lot, but where I think a lot still needs to be done in Europe. Sustainable finance, obviously, very much top of the agenda. The digital challenges, some of them have been mentioned in terms of crypto-type tulips and others. And the question is, of course, then to make sure that we have the right regulatory framework that goes with it. And then last but absolutely not least, the banking union and the capital markets union. From the European Commission side, we tend to always say that it has to be completed. The work has to happen now. I think we have said that for many years already, but it's never been as true as it is today. And it's really something where we need to get going, basically. On the banking union side, get going on ADIS, the Common Deposit Insurance Scheme, and of course, Capital Markets Union, which is not one measure, which is not one action, but very many small things coming together. And I think that's also really something that we will want to prioritize going forward. I will stop there. Thank you.
Thanks so very much. Kerstin, how does it look from where you sit?
So thank you, Rebecca, and good morning, everybody. Yeah, I mean, 2020 was certainly a very challenging year, marked by an unprecedented contraction of the economy and clouded by severe uncertainty. Thankfully, euro area banks stood up to the test and coped with the first economic shock of the pandemic much better than was the case with the initial hit of the great financial crisis. So not least because in this time, the economic crisis didn't originate from the excessive risk-taking. European banks' core capital ratios are at the highest level since the establishment of the banking union. And this means that banks have been and remain in a position to absorb a significant amount of losses and they can continue to support the real economy, households and corporates. I mean, as has been said here, there have been two key factors that has, also been very important for banks. And the first one is, of course, the overhaul of the regulatory framework after the financial crisis 2008. Banks came into this crisis with higher capital buffers, liquidity buffers, and a much better risk management processes. So these reforms have really been important, and we can see now that they are also giving us a good result. And the second factor is, of course, the broad support that government, supervisors, central banks, all the support that has been given to the real economy and to banks and to their customers. So I think from our side, we provided some capital relief to banks, and we also recommended banks to be restrictive on dividend payments, as we thought it was, and still think it's important that they have enough capital in this system to support the economy and to be able to absorb losses. I mean, as has been said here, we are not out of the woods yet. The pandemic is still ongoing, and its fallout is not yet fully reflected in banks' balance sheets. So thus far, the sharp decline in economic activity caused by the pandemic has not resulted in an increase in non-performing loans. But as support measures to banks and their customers are worn down by governments going forward, there is likely to be, an increase in the corporate defaults. So it is crucial that banks proactively manage their credit risk, that they reclassify loans on a case-by-case basis, and ensure the prudent provisioning. So, as mentioned, credit risk is an important issue for banks, but also for us as supervisors to challenge bank and make sure that they are, assessing the customers correctly in this point in time. For the rest, looking at the institutional arrangement, maybe we will come back to that, but it has been working much better as well with the single supervisory mechanism in Europe, with the single resolution authority, and with the fund as well as backing up. So the institutional system has also been working much better this time than last time we had a crisis. I will stop here. Thank you.
Thank you so much. Axel Weber, as we come back to you, I'd love if you could specifically talk about the global outlook and the risk of fragmentation and the efforts to push back against that. We have the EU, but also the UK, Switzerland, the US, Japan, the other Asian financial centers. How is that all working together, and what does it look like?
Well, it was already mentioned, I'll be brief. Look, we are at this stage where I think we've bottomed out in terms of the direct impact of the pandemic. We are on a trajectory for regaining pre-crisis levels of GDP. That will happen in stages. China has already surpassed that long ago. The US will get there fast with vaccination being rolled out and lockdown situation probably improving faster than Europe. Europe is somewhat slower. The US has done a massive fiscal and monetary stimulus program. So unlike in the last crisis, where central banks were the only game in town, now central banks are one of the two games in town. And, globally, central banks have augmented their balance sheet by 13 trillion. That facilitated a fiscal expansion to the tune of 11 trillion around the globe, and it will continue. So in a way, it's this time around, we don't just have monetary policy, we have fiscal policy as well. That, in my view, means the response is not only unprecedented, it is also likely to take much longer to be drawn back, for government deficits to start consolidating, and for monetary policy to retreat. So we're talking about years of an environment that is like this. On the banking side, look, I mean, banks have so far not been part of the problem. That's good, but it's not a prediction for the future. We discussed that before. But I think even if banks were to become a problem, and having been a former regulator, we're in a much better place now if that were to happen, because interconnectedness between banks, which was a big problem last time around, that's done. Banks have resolution and recovery plans, so individual banks will be much more in charge of their own fate, as opposed to creating a systemic risk for the economy. Now, going forward, I mean, what banks need to do and should have done all along is prudent risk management, whether it's non-financial risks, operational risk, talk about cyber, or whether it's prudent risk management. And diversification helps in banking as well. We've seen basically all our businesses be relatively profitable. And so globally diversified banks have much better ability to gain from the rebound of Asia and the rebound of the US before Europe is. The problem will be concentrated players. And if I can just make a comparison, because last time around when we managed the crisis, a large part was guarantees. I mean, in Germany, 80% of the money used by governments was guarantees for a time, and they were repaid. And the rest, 20%, was capital injections into problem areas. I mean, these were banks with capital injections, but it was other financial institutions as well. But it was the financial sector. If you look at what we've done this time around, we've largely worked with guarantees and expansionary fiscal and monetary policy. We haven't really seen, maybe outside the aviation sector to some degree, capital injections in the corporates. That will come, because you will see that there will be a distinction between liquidity, which is where we are now, and it's ample liquidity being provided, and solvency. And that's where we need to get it right. I think we've done a good job in preventing losing corporates that in principle might have a good business model after the crisis, financing them through that. But then, as we come out of the crisis, there will be some corporates who will not have a business model after the crisis. It's not a question we've asked so far. We really asked who is impacted by the crisis and how can we help them through. And that will be, I think, where the structural problems will reemerge. And that's where I think, what Mark also said, we need to be very cautious about sort of a too early sort of relief that we've managed through the initial phase of the crisis. This will be a really long haul crisis, and the last financial crisis will be a short episode as compared to the long-term impact this will have on government budgets, on monetary policy, and on the corporate sector, and by impact also on the banking sector. So I don't think we're out of the woods. I'm actually more skeptical. We're not even sort of in the fifth inning here. We're in a much earlier stage of the game.
We're in the middle of spring training, so this is very exciting. Baseball metaphors already. I, for one, can't wait. But since we haven't gotten to opening day yet, we might as well go back to bank regulation. And I now want to talk about Basel while we still have Carolyn here. And I would like to ask about the momentum of the Basel process, and also the risk that the deviations we've seen around the world might not be rolled back. We've seen the US go its own way. We've seen the EU delay some of its next steps, and also think about ways when it might want to customize, which is to say also deviate in different ways. So Carolyn, where do you see the Basel process standing, and what are the risks at the moment?
So, I mean, let me first maybe look back with the good news story. I think the Basel Committee stepped up big time over the last year. We ended the year, their last meeting just before Christmas was, I think, the 24th meeting of the year. So this is a committee that normally meets 3 times a year, met 24 times last year. So, made some really key decisions back to the flexibility, made some really key decisions early in the crisis to give operating flexibility and room to both its member regulators and international banks. So I think the Basel Committee did exactly what it was meant to do. It made key decisions up front, and then it stayed in very close contact and shared information continually throughout the process last year. So if you ask me, I think the committee has a lot of momentum and has stepped up to play its role. The interim measures have all been announced as temporary. So and I think they were the appropriate measures. I take the jurisdictions at their word, and as I said, the committee continues to share information. I think it is absolutely in the intent of jurisdictions to roll these temporary measures back when conditions allow for that to occur. So I don't have a lot of concern about that right now. I think the next thing that we have to focus on is finishing the job. So as you know, the final set of Basel reforms needs now to be implemented. This was mentioned earlier. I think the Commission is committed to putting out the proposal very shortly, in a couple of months. I have heard the arguments about, either we need more time, more delay. I come back to the fact that these we've already had a 1-year delay, and this is on top of a set of measures that have a very, very long phase-in process. So I think if we believe the narrative that the banks have been able to become part of the solution because of the global regulatory reform agenda, it doesn't make sense to me that we're now debating whether or not to finish the job. I think we have to finish the job. We have to continue to bring in a set of global reforms that both maintain a level playing field and continue to build on that necessary resiliency. So to come back, I gave a speech a couple of weeks ago that I'm pretty sure is on our website now, but I'll come back to the sports analogy. I often think of this debate around market fragmentation as sort of a multi-leg football game. So there's always the first round, which is here in Basel, and it's a well-fought match, and everybody comes with their list of particular things that they want to see bundled into the national set of rules. And so there is a long and detailed process that involves a lot of analytical work as well as a lot of debate negotiation. And we leave that match with a global set of reforms that is in itself born of compromise. Then what happens is they go back for the home match and the banks start all over again and try to make the argument that now that the national reforms have been settled, it's time for each jurisdiction to take account of national specificities, which sort of defeats the purpose of negotiating a set of global reforms. So I think what's really important now is that all jurisdictions take the multilateral process as sound, take the negotiated reforms, which include a long list of compromises reflecting individual jurisdictions around the table, and implement them in a timely and consistent way. And I think that will leave the international banking system, the international financial system sounder, more stable, and able to continue to be part of the solution coming out of this crisis.
Thank you. That was really informative. So Paulina, how about that package? When's it coming?
Thank you. Well, I think Caroline framed the debate very well and put it where it has to be. I mean, I think from the Commission side, we remain obviously very committed to the Basel process, which I think it's a good example of the international cooperation in general, which we think is a good thing, and it's better for Europe and better for the world if we try to cooperate. As others, we postponed the implementation of the last elements of the Basel reform in light of the global situation last year, and we are now committed to putting forward a legislative proposal in the months to come. So that timetable is certainly there. Of course, we are aware of the debate and the various views, but I think that we have agreed on something in Basel after long and hard-fought discussions, as Caroline mentioned. So it's only normal and legit and absolutely right that we implement it. Now, of course, we have then a process in Europe, as many of you know well, which is that the Commission has a proposal, and then we have, of course, the member states and the European Parliament, which is also the reason why sometimes what is in the end, on the statute book in Europe look a little bit different from the Commission proposal. That's of course also normal. That's part of the European democratic process, and that is the way our system works. We will of course also, in the same way as we are committed to bringing this reform into place, we of course will also be watching what others are doing, and hopefully we see the same level of, let's say, commitment and ambition from other global partners as well, so that we all together take these bits of these very important Basel reforms forward. Thank you.
Thanks. Kerstin, how do things look to you? And if I may put you on the spot, do you have any concerns about the level playing field globally and about the different specificities and measures and deviations that have come into play?
If I just can comment on the Basel regulation and the proposal, I think we are also very supportive to this international agreement. And I mean, it's well thought, it has been discussed for many years. So I'm always a little bit unhappy when I'm hearing wishes for delays again. I mean, there is already a rather long transitional period built into the framework. So I really hope that this will now come into force. We have quite many international banks with cross-border activities, Europe, Asia, US, and UK, of course. So it is important that we have a broad agreement. Then we have, of course, to closely in the Basel Committee follow up and evaluate the implementation. And I mean, we have also new risks. We have climate risk, which is an important factor. And we have other topics like digitalization that has also to be taken into account. And we have maybe also here to formulate our regulation and frameworks in more detail. On the level playing field, I mean, that is always a discussion, and I think we have done a lot since the last financial crisis. We can probably do more here, but it is all about making sure that we have a legislation in place that is more or less implemented in the same way in the different regions, and that there is also a close cooperation between the authorities so that we can make sure that supervision works well for the cross-border banks. There is always more you can do, but I think we have taken quite a number of steps here to improve the situation.
Thank you. Mark, as we come to you, you were hailed in the opening remarks from Elke König about your work on unallocated TLAC. So I'd love to hear some of your detailed thoughts about how the Basel regulations are working with the financial system and how maybe they're helping.
Yeah, well, they've helped. That's, I think, a consensus amongst all of us. There's also probably a consensus that the reforms aren't done. The Basel reforms aren't done, and the too big to fail reforms aren't done. If you're talking about our work at the FSB on resolution and getting the last pieces of the puzzle there together, and it is clear that we've slipped into the next crisis, not entirely a financial crisis, but a global crisis nonetheless, without having finished our work from the last one. That's what it is. But all of the things that we set out to do that haven't been finished are just as relevant now as they ever were. So I can't agree more with Caroline. I mean, Basel III just needs to get done. It's almost 14 years since the first shoe dropped in the global financial crisis, and this Basel III reforms, or the part of the package that hasn't yet been done, is all about getting unnecessary model complexity out of the system, unnecessary or exaggerated model optimization out of the system. It's broadly a capital neutral implementation across the system. There's no reason other than project management complexity not to get it done. And we didn't get it done before the COVID crisis hit, but it's just as relevant as it ever was. And we've got to be very careful not to have everybody looking over their shoulder and seeing how slowly the others are going, because then we'll just go at the pace of the slowest. And that's just not going to serve actually any of us, including the institutions that are affected, because I think they're probably sick of talking to their investors about the impact of Basel III as well, or Basel III, the final package. And certainty is better than prolonged uncertainty about regulatory change. So I think on the Basel side, it's a no-brainer actually, and it's not a masterpiece of international regulatory coordination. I think on the resolution side, a huge amount has also been done, but there are gaps. There are gaps on the banking side, which are rather more technical, or implementation gaps rather than policy gaps. So if I look at the work of the Resolution Steering Group, on the banking side, there's not a huge emphasis on new policy creation. It's pretty granular stuff, or it's about implementation. Where there's the biggest gap that's relevant to global financial stability, from my point of view, is on the infrastructure side, and in particular the CCP financial resources, where we've set out to get some more work done on that this year. Drawing together the resources of the FSB and IOSCO to work on this problem where there isn't enough consensus at the moment as to whether the CCPs are resilient enough. And we tested some aspects of that to some degree in the market turbulence last March. It wasn't all reassuring. Obviously, everything held, but we had some pretty dramatic turbulence and liquidity strains that came very fast into the markets. And so there are some lessons to be learned from that as well, which are partly new lessons and partly apply to the role of central counterparties. So yeah, we can learn from this crisis as well, and in particular the March 2020 liquidity crunch. But we have to get on with closing the gaps that we've identified, probably a decade ago. We should be a little bit impatient with ourselves.
That is a great summary of a lot of the things that are going on out there. And I also want to thank Kerstin for flagging the climate issue. We're going to discuss that a lot more on Thursday in our next panel in this series. So it's coming back. Axel Weber, do you have any thoughts about the Basel process specifically? And then also, if you could include in your answer your take on bank profitability and how that's going to affect things. We've talked about, or you talked about, the dividend restrictions, and we've talked about banks talking to their investors about the impact of coming regulations. So are you concerned about that? Do you think it's going in the right direction? Do you think what changes do you think are needed?
Well, I don't look at the Basel process as it was portrayed here as a process around certain discrete changes in Basel, like Basel I, Basel II, Basel III. Basel is a continuous process. There'll be Basel IV, there'll be Basel V. Regulation is a continuous process. And it is a response also to things happening. Mark said we've had 2 or 3 events in this crisis, which were new and they need to be addressed. We haven't put in place most of the sort of final steps on the interconnectedness between the central banks and their role as financing and banks in normal times, but then they have a role to play also in resolution financing. And that is something where the central bank in the Basel process, where the central banks are participating, really needs to be aligned about, what do we do if are there standing facilities for banks in resolution, which would mean in a way that since central banks operate on that, they will probably need a government guarantee for any losses coming under that, under such a regime. Now, that is already the case in some jurisdictions. It's much harder to do in others. So I look at regulatory processes not as Basel II, Basel III. We even disagree in the financial industry whether it's Basel III or already Basel IV. It's a continuous process of lessons learned in terms of responding to crisis. And as Mark said, the biggest downside we've seen is we thought we had decades to fix this till we hit the next crisis. Unfortunately, we just had a decade. And much of the stuff that sort of was postponed, delayed, not agreed upon early, really became, hostage to this second crisis. And coming out of this crisis, there will be new lessons to be learned. And I do think even the direction of travel for some of these regulations might change, because it's much more a knock-on effect on the corporate sector, from the corporate sector onto the banks that we're starting and have to start to deal with, as opposed to a direct impact of the crisis on the banks. And so banks are in the second line. And I think that will be very, very important on how banks will preserve their balance sheet. The whole discussion about lending, absolutely true. Lending is a key part of what we need to do, but many banks will be very prudent and will try and preserve their balance sheet once losses are starting to materialize. And then I think you would start to have a different debate about banks now being part of the solution. Could well be seen, if they preserve their balance sheet and their solidity, if they properly risk management, that they become part of the problem in their behavior in trying to insulate themselves from a crisis that wasn't originated in the banking sector. So I do think that we're in a very difficult point of this cycle. And going forward, I do think that banks will, we also have structural problems in the banking sector. The banking sector, in my view, is going through a major consolidation. It's going, there's too many banks. There's not enough profitability in the banking sector. There's scale issues emerging, and we actually dealt, after the last financial crisis, we dealt with scale as a problem. Now not having scale is becoming a problem. So I think directionally there are some changes that we see in the financial sector. And let me also remind us, there is a huge amount of innovation out there, fintechs and others, that are starting to disintermediate the value chain and the productivity of banks, going into the parts of their product chain that is the most profitable one to have, and offering services to banks. And banks might end up with a sort of a pretty fragmented business, where some of the more agile new players take away big profitable parts of their profit and of their product chain, and then banks end up holding the rest. So I do think this is a very difficult environment to deal with, and banks will have to react to the crisis, will have to react to the situation. Regulation, I must say, is our least concern. I mean, I would be very glad if we were to come to a steady regulatory environment, but I don't think that that is a likely outcome. So let's get Basel done. We shouldn't continue to have debates that are, a dozen years old. We should really focus our attention on the things that come out of this crisis and the lessons to be learned. Otherwise, we're like generals. We fight the last war instead of the current one.
Thanks very much. So we're heading into what I think will be our final round. And I'd like to have all of you thinking about your answers already. I'm going to ask you if you can think of any prudential measures that we need right now, and also if there's a single legislative action that can be taken at the EU level, one in particular that you think would make a big difference. We've certainly spoken generally about banking union and capital markets union and Basel, but I'm wondering if there's a specific thing that you would each put at the top of your wish list. Caroline, I'm going to start with you and also give you the floor if there's anything you want to respond to from the Basel round, since I know you have to go before we reach the very end. And thank you all again for your participation today. Really great conversation.
Thanks, Rebecca. I should just tell everyone the reason I have to go is actually for a Basel committee meeting. It starts at noon. So yeah, I might respond just to the collective feedback, but in particular to Axel's comments at the end. I think we're heading into a period where there is a premium on flexibility, and so yes, we do hear some hand-wringing by banks about using their buffers, but on the other hand, we've heard a few times. I think Axel mentioned this, and Roberto mentioned this too. We've seen lending go up. We've seen capital layers go up. So there doesn't appear to be a lot of constraint or deleveraging or any clear indication that banks are reluctant to use their buffers. We do have to keep in mind a lot of the lending is guaranteed lending, so won't necessarily show up in the capital ratios of banks. But the other thing I'd point to is that banks seem quite comfortable and in fact quite anxious to pay out capital in dividends and bonuses and buybacks. And so I think the picture of whether banks are prepared to use their buffers, I think the jury's out on that one. I know there's calls for reforms to be revisited or calibration or the allocation of capital across the various buffers to be revisited. But I think again, I come back to the earlier comments. We're early in the game. I don't yet see any indication that we need to make changes to the Basel framework. So back to the call to just get on with it. I will leave the specific question to what could be done in the legislative framework for European banks to my European colleagues who know this much better than me. But of course, my vote will always go to getting the final set of the Basel III reforms in. So I was very glad to hear the comments that the proposal's coming out soon. And I agree entirely that with Mark's comment that we can't all look over our shoulder and look for the slowest mover, that we should proceed ahead. So that would be my vote for the one thing that needs to happen in the European context.
Thank you so much. Mark, what do you think?
Well, I certainly wouldn't from outside want to comment on the way the European environment could develop, but I think very generically for us all, and that's a global question. We've said it. One, finish the work that we've had on the table for a long time. Two, learn the lessons of the COVID crisis that we've seen until now, and there are lessons to be learned, in particular in non-bank finance, especially from the turbulence of March 2020. We shouldn't forget it, just because there was a global health crisis developing at the same time. And then, actually, I think if you talk about legislative responses, other than those two buckets, I'm not sure that's what it needs. I think at the moment, what you need is prudent risk management in the industry and strong supervision from the public sector, because my biggest concern is excessive risk taking on the prudential side. Maybe criminal activity on the conduct side. They're always excessive risk-taking, criminal activity, financial crime. They're always like water trying to find the weakest part in the geology, and that needs massive attention. And the more there is a risk of exaggeration, the more that attention needs to be sharpened. And no supervisor can find all the problems in advance and stop them. And what we see is the result of the ones that got away. But every supervisor needs to be absolutely on their game at the moment to try and make sure that exuberance doesn't lead to damage in financial stability or in for the clients of the various financial systems. So I think we need more and intensive supervision now, and finishing the job, rather than dreaming up new regulation.
All right, thanks very much for that. Kerstin, what do you think?
Oh, thank you, Rebecca. Yeah, I can just agree. I mean, we need strong supervisors, so that's very clear. But I mean, I think if I look at the European banks, they have also still a home lesson, not linked to the crisis now, but already before the crisis. I mean, we have quite low profitability in many banks, and there is a need for probably more consolidation in the banking sector. Banks have to review their business models. They have to take digitalization into account, and so on. So there is more to do. We need to also look at the structural changes, which are not necessarily linked to regulation, but this is something that has to be done. And we as supervisors try, of course, to challenge banks on their business models and making sure that they also can be viable for a longer period. But this is a hard job, and which also takes some time. If I can have one wish on the regulation, I think that would be to make sure that the third pillar of the banking union would come into place. The third pillar is the European Deposit Insurance Scheme. I think that will be a very important step for the euro area and for the banking union. It will further, deepen the integration of the European banking market. It will also help us to have less fragmentation and have more cooperation between home and host. It will create more trust, and it will also help us to deal in a better way with the smaller banks and make sure that they can exit the market if needed. Thank you.
Thank you so much. Paulina, you're in the hot seat on the regulatory front.
Thank you. I think a lot has been said already. I think there's not one regulatory measure that is the answer here. And in any case, it could be a bit pretentious of me to trying to identify that. As mentioned, we are working on a proposal implementing the last elements of the last Basel reform. We will also be looking at later this year and next year to our macroprudential framework to look through that and what we may need to be updated and revised. I think that's quite an important reform, which will also obviously also be looked at from the perspective of what lessons we have drawn from the situation we are in right now. Banking union, of course, super important. I mentioned EDIS. I was very pleased to hear that Kerstin mentioned it as well. I think the common deposit insurance has been with us for many years now, and it would be very good if we manage to make progress. Sustainable finance, the digital agenda, I've mentioned already. Capital markets union, super important. A lot of different measures. I think on CMU, the low-hanging fruits are not so difficult. I personally think that we need to also look again on some of the not so low-hanging fruit, which is of course supervisory dimension, but also insolvency laws, which I think over time is something that is quite important in this context. There is of course also a broader context which goes beyond legislation. We speak about the level playing field globally between the EU and the US. Of course, the UK now also being let's say, an other element in that equation, looking also to Asia. But I think we also have level playing field issues if we look at Europe. If we look at even now in the crisis, all member states have used payment breaks and moratoria, but in some member states they've been used to a much higher degree and in other member states. And that of course also will have an impact when we look at the time with which these measures are phased out. Axel was mentioning earlier that the amount of state aid has not been that high in Europe yet. I think there has been quite a substantial amount, but more importantly, it's clear that some member states have given and have the capacity of giving much more public support than others. I think all these issues are basically also something to be looked at going forward. It's not only about regulation; it is about the more general picture here. And to finish off on the very macro level here, which is that obviously where our economy will be later this year, in a year from now, in 2 years from now, is of course also very much dependent on what happens more generally in the fight against the pandemic, and notably the speed with which the vaccinations are being rolled out and all that. So there is really like all the different levels of challenges here that of course all play together. But thank you again for the opportunity to be with you this morning. Thank you.
Thank you so much. Axel Weber, the last word goes to you.
Thank you. Well, I'd like to make 2 points. The first one is when you look at banks, particularly the global banks, what is increasingly important for our operations is not just our European and home market, but also our US and Asia operations for global banks. Now, China has size, the US has size, Europe has potential size. What do I mean? Europe is a market of 27 fragmented economies with a 28th regulator on top. You wouldn't design a system that was efficient if you could draw on a fresh piece of paper in that way. You would draw a system that basically opens the internal markets, has a single regulator and a single rule set. Now, we're coming to this bottom up by evolution from national systems with regulators nationally and parliaments nationally on the break. We need to start a rebuild at the European level and start with a single layer from the top. I think this will not evolve, and if it evolves, it takes 100 years. By that time, we've lost the race. So I think Europe needs size. It has potential size, but it will only come if fragmentation goes fast. Second point, look, if Europe is not fully on board for Basel implementation at any point in time, it will be globally seen as a weakness. It will be a weakness that banks cannot overcome with their own levers, because the US, Europe, Asia, everyone will measure Europe, and European banks are viewed, if you compare them to Asian or American banks, I'm not talking about Swiss banks here, because we're the host of this meeting, are looked as the weaker of the players. If you delay global regulation in the weakest constituency, seen from the market perspective, it's a net negative for the banks, and it could be seen as something that is very hard for the banks to overcome, however strong they are. So I think there is a tendency in the crisis that we try to hide the stronger banks with a lot of hands-on regulation in a clear obscure behind the weaker banks, so that the weaker banks wouldn't be singled out and face idiosyncratic problems. We got to overcome that at some point. Now, it's probably not the time now, and as I said, we're not in the fifth inning yet, so let's wait. But let's not delay the regulation that should have been done 12 years ago, and get it done and focus on the things that need to be done for the future, and avoiding a regulatory level playing field by falling back on regulations like Basel is a very uniquely clear sign of weakness, and Europe shouldn't give itself the exposure to that weakness.
Thank you very much. Thank you to everyone for your participation, for sticking with us this morning. I know there's a lot going on, and I hope to see you back on Thursday for the second half of our conference. Thank you to the organizers, and thank you to all who've participated today.